something I don't want to move past because I think this is like the crux of investing that I think a lot of people get stuck on. And if you listen to a lot of podcasts, I think they kind of glaze over the details of this. So what I'd love to do is just address it from a two-part kind of like function. The first part is, if someone's listening to this, how do they go about finding those people or having the conversation? And then the second part is, if we could just dig into quickly the structure. You gave a high level of it, but I want to walk through like the actual logistics of it, like how much of ownership, how much of cash flow, and then how that refi would work a little bit. But
Yep.
let's start with the first one. Someone listening to this right now, and they're thinking, that makes sense. I have hustle, I have energy, I have the ability to manage a deal. I've been researching. I may have even done a couple deals so far, but I'm out of money. So what would that person do right then and there to find money in their network and have that conversation?
So again, it all comes back to initially, you can't do this with a two-family, right? This is not, you've bought your first residential property. Any investor, any savvy investor outside of somebody who's in your family, right? If it's your aunt or your uncle, you may be able to pull this off and get that going because they love you and they want to see you succeed. But anybody else in your network may want to see a little bit more of a resume. So that's the first thing. The second thing is we talked about is the brand building. You can't be in this business and be quiet about what you're doing. You have to, people see when you're not serious about this, right? The people are comfortable lending to me because they know at the end of the day that I live, I breathe, this is me, this is who I am. And, I'm not going anywhere. I put myself out there. So that's the other thing is really, truly, if you don't believe in yourself, no one else is going to believe in you. So that is, going out there, finding yourself and then showing people your resume taking people. The other thing that you can do is you can organize, let's say, I used to do webinars or rehab tours. I still bring people out to the properties that I'm rehabbing right now and just say, hey, let's walk through. And this is how I found the deal and everything else. And there are going to be a lot of people that say, I can't do what he does, but I do have a good amount of money and I'd like to invest with him. So you're going to meet people that way, putting yourself out on podcasts and networking meetings and wherever else you can, bigger pockets, getting on bigger pockets and stuff like that, and kind of just showing off your deals and putting blog posts about, the latest deals. But that's the branding side. When you talk about the specifics, right?
Mm-hmm.
And I'm going to kind of circle around here. So hopefully I don't lose anybody and I don't want to get too lost, but there are two ways to raise money. It's debt and it's equity, right? So let's break down the debt side first, because that's really the simple side. Debt is just like, let's say, for instance, the bank wants to give you, excuse me, let me back up for 1 second. You're not going to be doing this in your own name, right? That's first off. When you get to a certain level, that first 2, 3, 5, 8 properties, you're probably buying it in John and Willie's personal name, your personal social security number. There's a certain point where you're going to convert and start using LLCs. You're going to start buying things in other entities, right? LLC, super simple to set up. You can set it up in one day. You can go to irs.gov, get yourself a separate tax ID, and you have another company. So it's 123 Main Street or whatever the name of your LLC may be. And a commercial lender would now lend to that LLC. And let's say they're going to lend 80% of the purchase price to the LLC. So you still need a 20% down payment. And here in the Northeast, let's say that's $100,000. Debt, the debt partner would say, I would basically go to them and I'd say, hey, I know you have $100,000 sitting in your retirement fund or your personal checking account. I know right now you're earning 1%, in that, sitting in that checking account or that savings account. What if I was able to give you 12% on your money over the next year, right? They come in, they say, yeah, this is great. We sign a short-term promissory note. The attorney can draft it up for you really easily between Jonathan and Willie. Jonathan gives Willie the $100,000. I'm paying you 12%, which is $1,000 per month. And I'm going to take your $100,000, use it as a down payment on my commercial note. And the reason they allow me to do that is commercial is a little bit different than residential. They care less about where the money's coming from and stuff like that. Obviously, you can't be a drug dealer and, they don't want you to be a money launderer. But I mean, there's less of concern about you having seasoned money in it, be in your account for 2 months and everything else. Sure. Take that, use it as a down payment. I now own the property. I'm going to fix up the property, do what I need to do, get it stabilized, and now it's cash flowing. And the ideal situation is I bought a property that's not only paying the bank back, but also paying you back. And what I'm going to try to do is at the end of that 9 months, 10 months, or whatever it may be, I have the property stabilized. I'm going to refinance the property and consolidate your debt and the new bank debt into one loan, taking the cash out that I took and paying you off. I know if you're not in this business, that's probably super complex and you're probably like, what is he talking about? We're doing half of that things, but that is the the BRRRR strategy, the buy, renovate, rent and refinance strategy. That's kind of the 2.0, or the next level of this. And then give me 1 second. The equity side of it is very similar, but instead of John, you being my debt partner and me paying you, you're going to come in that $100,000 that you're now giving me, or buying the property. You are now an equity piece. And the question that you had is, how do you determine how much, right? I'm 100% owner. You're giving me the $100,000 to help me purchase this property. How much do I actually give you? Well, the question is, how much money is going to come out of the property, right? And I try to get you to a point where between the appreciation that's estimated, the debt pay down, and the cash flow that's coming out of the property, I try to get you to achieve, let's call it a 15% internal rate of return. And that all that internal rate of return means is it's the combination of the appreciation, the debt pay down, and the cash flow that's coming out. And it's basically your return on investment with those three things combined. I try to get you, let's say a 5 or 6 is not sweet enough for you to kind of come into this deal, right? You can probably achieve that in the stock market. 20% is I'm probably overachieving for you. I try to get you somewhere in between, somewhere around a 12, 13, 14, 50% rate of return on your money, where I can say, this is a pretty good deal for you. You're going to achieve a lot more than what you would in the stock market, but I still receive. So I give up enough equity to you to achieve that number. So if it's 20%, if it's 25%, if it's 50%, whatever that number that of ownership that you would need to own to achieve that return on investment, if that makes sense.